So what was your reason for setting up a self-managed super fund?
Because I bought this unit in there.
So your sole reason
Yeah.
was to say, I want to buy a property, an asset that is property, whether it be commercial or resi. I'm going to forgo what I've got in a normal industry fund and take that across because of your business, wholly and solely, or potentially with the results it could give you?
Oh, look, I think I wanted to, because I had a decent super balance, and for my life stage and age and what I needed, it was just a better use of my super to buy a commercial unit. And so basically now my company rents off my super fund.
Yeah. So there's that side of things. If you weren't a business owner, would you have done it?
Well, I wouldn't have, no. And that was like old mate that I was talking about before. They're buying a commercial property in their super fund, and like I'm just not doing investments like that in my super fund.
Yeah.
Like,
do you look at it and say, okay, I've got, let's say this costs $200,000. Do you look at it and say, well, now I've leveraged that amount. I've got $200K of real estate here that if it performs at 5% or 7%, then that's better off because I've still got my cash amount in my super that I can invest as well as the asset?
Yeah, so what I want to show you, John, is with borrowing, I set mine up so I put a higher deposit in so the rent would cover the P&I repayments.
Okay.
And a little bit more.
Yeah, which is common.
However, the example we're going to use, it's very interesting. And I will say a couple of, flag markers. With self-managed super fund, you can't buy a property, a residential investment property, and live in it yourself. You can't have your kids live in it, your parents live in it, your cousin live in it, any related party, you can't. If you've got an existing residential property, you cannot sell that to your self-managed super fund. However, if you've got an existing commercial property, you can move that into your self-managed super fund.
There's lots of no-goes for property types.
So the assumption that we've used, and I might actually share this for those who are watching it on YouTube. I'll just make sure so if you are watching on YouTube, you've just seen my really primitive workings. You won't need to see that, John, because you can see it there on your screen. I just loosely crunched this in Word and we'll read it out. So the purchase price, $700K for a property. We need to set up a separate trust because the way that the super rules are, the super fund can't borrow money effectively. So you have to have a trust that borrows the money, and it's effectively a second entity that's set up. So I've got a self-managed super fund with a corporate trustee, and the Bear Trust is another little trust with a company so all this crap just adds up, right?
They're one-off fees initially.
They
like
are.
The Bear Trust, etc.
Yes. Yeah. And you don't need to do an annual financial audit on the Bear Trust.
No.
So assuming a 20% deposit, you're going to need 140 grand of meat.
And some banks, and again, there's not many banks left that will actually loan.
No, they're all kind of third-tier lenders now.
Yeah, so some actually require 30% to get a better interest rate as well.
That's right, and there's generally as well. It's a bit of a you want the money you pay. Like you can see here, the interest rate's over 7%, so it's going to be a couple of percent more. Could be up to 3% more. Now, the stamp duty will be $30,000 and you wouldn't borrow that, and a couple of grand for legals. So based on a $560,000 loan, and the loan's called a LRBA arrangement, limited recourse borrowing arrangement, which basically says it's limited recourse. So if your super fund stops paying, the bank can't go after the other assets within the super fund. And the dumb thing is, the bank or the lender will make you sign as a director for liability. So which is odd, but sure. So they'll come and get you. So if we have a look at the balance required, $140,000 plus 30 grand stamp, maybe some setup costs of $3,500, you're looking to knock on the door of a $700,000 property, $173,000. Okay.
And just to add in there that the stamp duty is going to be different in each state.
That's right. We just used a bit of a
New South, like exact is 26,
right,
but Victoria is 39. So it's we've gone somewhere in the middle a little bit.
So let's have a look. A loan, 30-year term for the 490, here we go, 20% deposit. So the loan is 540, 30 years. We'll assume 4% gross rental yield, but I've just assumed $3,000 for agency fees or any dickery throughout the year, Johnny. So the loan repayment on itself is $44,000 P&I. You can't get interest only. Mm-hmm. So there's a whole of $17,000. Does that make sense?
As a shortfall?
Yeah.
Yeah.
Now, if you increase the deposit to 30%, you'll need $210,000 because this is where you start playing with the cash flow, and that's why I put a higher deposit in. If the rent was 25 net, the loan repayment's 40 now, not 44,000. There's still a neg 15K a year difference. Yeah. So the question is, where is that difference going to come from?
Yeah.
Now, sure, it could come from your superannuation guarantee payments, so your employer contributions. But between you and your partner, if there's two of you, do they net at, after contributions tax, of 15 grand a year? Not sure.
Well, and you ideally want the super contributions to be growing your cash amount, don't you? Not
That's right.
Just covering your holding costs.
Yeah.
Because the tax situation is different inside super versus if you had a negative 15
That's right.
in your personal name.
So, for example, it moves you into negative gearing territory because you can still, quote unquote, negatively gear in the super fund.
Yeah.
But it's only because the tax rate's 15%.
You can only claim at 15.
Yeah. So a couple of things here. You can't use equity. You can't, can't do that. You can't, we talked about living it. You can't renovate it with your own money. So you can't be like, oh, we're going to put a balcony on the back. I've got 30 grand that I won on the pokies. I'm just going to put that 30 grand. No, that's a contribution to super, number one, because it's in super. So you can't do that. You can, for example, use cash in the super fund to do maintenance and minor refurbishments. So we're going to do the kitchen or the bathroom. You can't refi it and cash out and get equity and do a knockover rebuild. Like, it's a one and done.
Yeah. So what you're saying when you say you can't use equity, if your asset of 700K grows to $1 million and you've got a loan of 500, then essentially in your personal world you would have
you could borrow 400,
$300K at least to take out and go and do what you want, provided the servicing was there. You can't do that in your super. You have to sell the asset, keep it in there, and then buy again, and basically trade one for one.
Yep.
And the other part of this is you can't have a two-part contract.
No.
So it's got to be one
You can't build
contract.
a property, You can't build a house and land and then the land. Another thing as well, and I'll get you to speak to, the house and land. One cost that, and this is because there's probably 3 or 4 lenders who actually do this now in Australia. When you go and get a mortgage, the bank will send out a valuer and pay for it and all that. A lot of the times you're paying your own valuation.
Yes.
So these lenders, they're not
1,000.
like, I'd had to pay, I think, $3,500 or $4,000 for this. I'm like, give me a break.
Yeah.
So
for evaluation.
It's not as if you're refinancing every year because of the costs involved.
Yeah.
So if you're buying a property with your super, you want to make sure that's the property you want. You want it long term.
Yeah.
I just think there's more reasons not to than to.
Yeah. There's a lot of I suppose, rules and regs that you just don't have in your personal name. And if you're a property head and you want to take that over into your superannuation, you've just got to really just know the pros and cons and not be sold the sizzle by someone that really just wants you to set that up.
Yeah. And we'll also add, if you're buying a commercial property, if there is a tenant in that property, it's called a going concern. That means you don't have to pay GST. However, if there isn't a tenant in that commercial property, and this is the same inside or outside super, if there isn't a tenant, you'll have to pay the GST. Now, the trick and the problem is you can't borrow the GST. So if this 700K was a commercial property and there wasn't a tenant in there, or it was a new off the plan or whatever, you need an extra 70 grand to cash flow the GST.
Out of your own pocket that you can't lend.
Not out of your own pocket, but out of the super fund.
Out of the super's pocket.
That's right. Now, I haven't seen this in a while, but depending on the lender that you use, some of them will require a 10% liquidity of the property value upon settlement, which means property settles, 700 grand, you need 70K.
Yeah.
Because the thing is, you've got responsibilities as trustee. You need to pay the contributions tax, needs liquidity out of that. The bank probably want it more so they can get their repayments as well.
But you could claim the GST back.
Yes, if your super fund was registered for GST, yes.
Yeah. Yeah. So it just for the listeners, it's not 70K down the drain, never to return again.
No, but speak with your tax professional on that.
There's a lot of hoops to go through.
Yeah. So, but you still need to cash flow it if that's the case.
That's right. Absolutely.
So the new home trap, 10 years ago, it was rife where you'd go to the property seminar and the next minute you walk out with a self-managed super fund, a mortgage, a brand new property turnkey in an estate. Happy days. What could go wrong? We're not seeing it as much now because I think it's harder to lend because not every bank does this.
Yeah, I don't know if COVID got in the way of that or not, but I don't know what's
I reckon the money was harder
in that space,
but more complex.
The lending's definitely tightened since GFC, no doubt about that. So that was 14 years ago. So definitely since then, less of that we see happening anyway. But yeah, the fact is there's still a lot of new homes getting built. There's no doubt about that. But we don't hear a lot of it being in there in the self-managed super fund.
But the problem with this racket that was going on, it was the one-stop shop that had the accounting arm, the finance arm, and the property arm. So the accounting arm, they got $5,000 and probably a couple of grand a year extra work, tick. The broker arm got their $4,000 or $5,000 mortgage commission, tick. And none of these are bad things on their own right.
It's just a one-stop shop.
And then the property arm, I can tell you someone was getting $30,000 under the table not disclosed as well. And you were in an estate that was oversupplied, the yield was not there, and it was just a complete debacle.
Yeah, especially if the last part of, the asset actually isn't performing for us and it's oversupplied and I've got vacancies and I've got holding costs that I wasn't explained were going to be there because all of the sell was the positives of it and how it can look like in 10 years' time when you retire.
Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.